What's up, everybody? Sorry for the technical difficulties. It's my first live stream on Facebook, and it doesn't let you do landscape mode. It only lets you do portrait mode. So we had to kind of stop there and restart. So hopefully you've been able to tune back in here. Yesterday we had basically a big stock market drop. It was pretty far down. One point closed about 2% down during the day, and so I'm going to talk today about kind of what prompted that, why the market started to sell off so severely. And if you were paying attention to the news at all, you probably heard the word yield curve and yield curve inversion coming around a little bit. And so we're going to talk about what that means, why that made the market sell off, and what that means for you and your portfolio, and how you can kind of protect yourself against it. So basically the yield curve inverted, causing this market sell-off. So before we can talk about why it made the market sell off, we have to talk about what the yield curve is and what it means for that yield curve to invert. And before we even get into what the yield curve is, we have to cover bonds. So basically a bond is debt, right? It's you loaning the government money. There are corporate bonds as well, and muni bonds as well, where you can loan money to cities or to companies. But specifically for this, we're going to be talking about treasuries, which is loaning money to the government. So when you loan money to the government, it creates a bond, and they pay you interest for that, for the privilege of using your money, and you get to collect that interest. Usually it's semi-annually. That's twice a year. Now, when you loan somebody money, and you get a return and interest payments on that, you'd expect that you can charge a higher interest rate if the loan is for a longer amount of time. If you've ever gone out shopping for a home and you looked at mortgage prices, you probably noticed that you could get a better interest rate on your mortgage if you got a 15-year mortgage versus a 30-year mortgage. And that's just due to the risk of tying up money for that long. If they're going to have their money tied up for that long, they want to get compensated a little bit more for it, for having it, a longer-term debt obligation. So it's the same thing with the government, right? If you have your money loaned to the government for 2 years, you're going to probably expect to have an interest rate paid to you that is lower than what you would normally have if you had if you had a loan to the government for 10 years, just because of the time, right? So that's what normally happens. A 2-year Treasury bond is going to pay a lower interest rate than a 10-year Treasury bond, just like any other debt out there, like mortgage. What happened yesterday was that normal difference flip-flopped. It switched. Now, that is called a yield curve inversion, because if you imagine a graph where you are charting the yields or the interest rates on the different loans or the different bonds, going from a very short amount of time all the way out to 30 years, that's going to create a curve where you see the amount of interest you're getting paid for the amount of time that loan is going to be outstanding for. And so when the 10-year dropped below the 2-year in terms of how much interest it was paying, that's called an inversion, because now the chart is flipped. Now the longer term loans pay less than the shorter term loans. Essentially what this says about the economy is that you have less confidence in the short term of the economy than you do in the long term. And so you want to be compensated more for the short term rather than the long term. How does this happen though? How do the yields actually change? Because doesn't the government just issue a bond and it continues to pay the same interest? So how does the yield actually change? Well, it's supply and demand. So if I loan you $100 and you pay me $2 every year on interest for that loan, let's say you become a pretty worthy debtor, and you're always going to be paying that interest on time. that bond, that loan is going to be worth something to other people who want a secure source of money, right? So what they might do, what I might do in this case, is I might sell that loan to someone else. If you have a mortgage, you might have experienced this, where you start a mortgage with one company and they sell that mortgage to another company. And so instead of making payments to the company you originated your loan with, now you're making payments to a new company. That loan got transferred, it got sold. The same thing happens with bonds, but supply and demand is going to affect the price that bond, that value of that bond. The dollar amount that the bond pays for the actual original amount of the loan is going to stay the same. But that $100 loan that I gave to you, if somebody else wants it more than I do, I might charge them $101. So they're going to pay me $101 for a $100 loan that's going to pay 2%, but it's paying 2% on that original $100, not on $101. So that means the actual yield on that $101 is under 2%. And so what you see this happening with government bonds, with the treasuries, as supply and demand goes up and down for the different maturity dates. You see that buying and selling and supply and demand pressure move the values of the bonds up and down. What this means then is that people are piling into the longer term loans. They're piling into the longer term bonds. Institutions are piling into the longer ones before they're piling into the short ones, and they're maybe selling the short ones to get into the longer ones. So you end up having this inverted yield curve because the price, the value, what people are willing to pay to get into those bonds is going up, and so the actual yield on the money invested is going to be lower. And so why does this happen? Why does that make the stock market crash? Well, number one, this is kind of a self-reinforcing prophecy because the last 9 recessions have been preceded by a flip in the yield curve, an inversion in the yield curve, where the 10-year and the 2-year Treasury flip in terms of which one pays the most interest. And so the 9 out of the last 6 recessions have been preceded by something like this. Now, all this is telling you is that there's just a lot of money pouring into longer term bonds, which means that there's already fear of the economy, fear in the market. And even to get that money, a lot of it is coming from the stock market. So it's a little bit of a self-reinforcing prophecy because the yield curve inverts because there was fear and there was money pouring into longer term debt, which is considered a safe haven, which made that yield curve flip. But that yield curve itself is a prophecy of a coming recession, which means that people are going to sell even more stocks to go into safe things that are considered safe assets. So it's a little bit of a self-fulfilling prophecy. Now, it got a lot of news, the market drop yesterday, because of the yield curve inversion, and it hasn't happened. I think 2006 was the last time it happened when it predicted that recession. But the market drop itself of 2%, if you watch the market at all, you know that's not enormous. In fact, just a week or 2 weeks ago, when Trump threatened the new tariffs that he's now called back, the market dropped the same amount, a week or 2 ago. So right now there is just a lot of volatility in the stock market, and because of that, there's more and more money piling into what's considered a safe haven or conservative assets. So that's what a bond is. That's how it pays. The supply and the demand of the actual bond itself is going to be what drives the interest rates going up and down. And that caused the longer term debt yield to become less valuable than the short term debt. And so that caused that yield curve inversion, which made money fly out of the market even more. Now, the most ironic part about this is that bonds, especially U.S. Treasuries, are probably the most risky asset out there right now. Maybe cash would be a little bit more risky. And the reason is because this next recession, it's not going to be a deflationary recession. It's going to be an inflationary recession. The difference between the two, in a deflationary recession, that's something that if you met, like the worst one we've had is the Great Depression, right? the money supply contracted like crazy, the economy contracted like crazy, and money itself got a lot more valuable. You could buy a lot of stuff for the money. The problem was nobody had any money, so the money supply itself contracted. So it made each dollar, each penny more valuable. Well, the next time around, when that happened, we were on a gold standard. The next time around, when this happens next, it's going to be inflationary. And the reason that we know it's going to be inflationary, well, I shouldn't say we because most people aren't saying this, but the reason that I believe very strongly that it's going to be inflationary instead of deflationary is because we just had 10 years of stimulus. After the last recession, the government put a Band-Aid on it, absorbed all the risk, absorbed all the bad debt, absorbed all the bad assets, and did that by printing money. Now, the rest of the world wasn't prepared. And so what they did is they absorbed all of that inflation. They bought up US Treasuries, they bought up all the debt that the government created in order to absorb the US bad investments, and they absorbed and they took on that inflation themselves. It's just central banks. They weren't looking for a good return on their money. They were just looking for something to do with their money, and historically, America has been a safe haven. But America has kept on printing more and more money over the past 10 years. And what the interest rates recently got lowered again, which means that if we're in such a great economy right now, why did they have to lower interest rates? Lowering interest rates is something you do when you're heading into a recession, when you're heading into a bad time, when you're trying to correct something, fix something. They say it's just to keep the expansion going, but the Fed never actually says what they think, otherwise it would cause the panic they're trying to prevent. So we have the great chance for an inflationary recession, because as soon as this bubble gets popped, as soon as the stock market really starts to sell off, we have more than a 2% drop, you're going to see this wealth effect reverse. In order to meet obligations, in order to pay back debt, people are going to have to sell their assets at fire sale prices. That's going to drive prices down even more. And the only way to fix this is for the Fed, they're going to print more money. And what that's going to do when you have inflation run rampant, when there's no growth, it causes stagflation and hyperinflation. That makes the dollar worthless, and it makes debt denominated in the dollar worthless. And so all the central banks around the world, especially China, that absorbed all this debt from us in the last 10 years, what they're going to do, they're just going to sell it. They don't care if they're going to sell it at a huge loss because it's only going to get worse. And so there's going to be a fire sale on US Treasuries. And when there's a fire sale on US Treasuries, that's going to make the values of those bonds plummet. Well, like we discussed earlier, there's an inverse correlation between the value of a bond and the interest rate, right? And so interest rates on treasuries are going to skyrocket. If the value drops, then the interest rate is going to skyrocket, right? Because right now the value is increasing, so the interest rate is dropping. The opposite is going to happen because all the central banks around the world are going to unload all the US treasuries because they're going to realize they're worthless. All the government's going to do is keep on printing more money. So what's the Fed going to do to prevent the collapse in the value of the treasury? They're going to be the ones buying these treasuries. There are no other buyers in this situation. So the Fed's going to be the one that's going to have to step in and buy all these treasuries from the rest of the world. And the only way they're going to do that is to print more money, which furthers the problem. The dollar collapses even more. And this time we're not going to see the inflation hit assets like the stock market and real estate like we have over the last 10 years. We're going to see the inflation hit goods and services, and the cost of living is going to go up. You know, the Fed keeps on talking about that, you know, we need to hit our 2% inflation rate, and it used to be a 2% cap on inflation. Then it was a 2% target, and now it's a 2% floor. And because they're trying to look back and say, oh, well, we haven't had that much inflation, so now we need to make up for it. Nobody would complain if prices went down, right? There's not a single person I know that would complain if their cost of living went down. Nobody's saying, oh man, I wish my cost of living was going up more. That's what happens when prices drop. Cost of living drops, right? So that's a good thing. But the Fed needs to do something about all this debt that they've created. And so they're brainwashing the public and especially financial advisors into thinking this is safe, that bonds and treasuries are safe and that the US dollar is safe so that they can inflate away the problem that they've created. But it's only going to make it worse. So it's a little bit ironic because this flight to safety is pushing a lot of institutional dollars into bonds, and those are probably going to be what collapses. And the central banks, the biggest players in the world, know this, and that's why the central banks around the world are stockpiling on gold like crazy. There's almost a gold rush globally for in central banks buying up gold because they kind of see this at the end of the tunnel. And so they're trying to diversify away from treasuries and the US dollar so it doesn't impact them as severely as it would for some of the countries who have no hedge against inflation. So that's what's going on right now. The yield curve inverted. It's going to pop back hard with a vengeance soon here. I don't know when, but the more air you blow into a bubble, the sooner it will be that it will pop. So that's the yield curve inverting. That's what's happening with bonds. That's why the stock market sold off. And if you're somebody who's recently gone into bonds for a safe haven for your money, that's probably one of the worst moves that you could make right now. At least with stocks, they'll come back. You know, it might take 5, 10, 15, 20, 25 years, but at least with stocks, most companies are not going to go bankrupt. They'll still find ways to make money in the future. But with government debt, all you have to do is say, we're not paying it. Or what they'll probably do is just inflate it away, which will be more painful in the long run. If you do want a way to hedge your portfolio without having exposure to just cash, which will lose its value, or bonds, which will lose their value, you can. I just put up a podcast today. It's on Spotify and iTunes. My episode I put up today is about using options to hedge your portfolio. And what you can basically do with options is purchase insurance on the value of your stocks. And so you essentially you're protecting yourself without exposing yourself to something that might be even more risky than your stocks. So I'll stop there. If we have any questions, we're going to do a little Q&A session here. And so let me pull it up here to see if we can do a Q&A session here. Do we know how to see questions?
They'll just pop up as comments.
Are they popping up on there?
Nobody's asking any questions. People did jump in about maybe like 2 or 3 minutes in, so you could talk about beginning stuff.
Okay. If you missed the beginning of the live stream, we talked about what a bond is, because that kind of laid the foundation for what the yield curve is doing. And so basically a treasury, which is what the yield curve is talking about, is the rates on treasuries. It's just a bond. It's debt. And so if you loan me money and I'm paying you back at interest at regular intervals, essentially what that is that's a bond. And so that's what a treasury is. It's just a loan to the government. You've just loaned them money and they're paying you back interest. And so there's a market for that debt, and it's just bought and sold and traded between people. And the supply and the demand of the market makes the value of of those treasuries go up and down. And so that's what a bond is, and that's why the yield curve inverted, because the demand of the longer term bonds became more than so much more than the demand for the short term bonds, that it basically suppressed the interest rate, because the value of the bond went up, so the interest rate went down. Were there any?
No, but
okay.
So maybe address the question of then how come I've been told my whole life that bonds are the safest thing ever?
Yeah. Why would bonds be considered one of the safest assets out there? For this one, you kind of have to follow the trail back to its source. Who is the person that has told you that bonds and cash are safe? It's probably your financial advisor, right? Anybody who's ever been through any financial training. Well, financial advisors, they have to get licensed, and those licenses, for them to practice, they have to be able to follow kind of the guidelines that those licenses prescribe for them. Otherwise, they'll lose their licenses. So things like suitability and making sure that the investments you're recommending to somebody are suitable for the situation that they're in. So with the financial advisor, getting licensed, they're going to go through a training that basically says bonds are safe. Well, who comes up with those licenses in that training material? It's FINRA and the SEC. FINRA is an organization that it's overseen by the SEC, and the SEC was was created by Congress in 1934. And so if you follow that little, that yellow brick trail all the way to see who's the man behind the curtain, it's Uncle Sam himself. So the person that's telling you that cash and government bonds are the safest asset out there are the ones who stand to benefit from you thinking that. Because if the rest of the world knows that they're not actually safe assets, everybody's going to sell them, and then that's going to hurt the U.S. government, right? So they want to keep this facade going as long as they can, so that they can, so nobody catches on, basically.
All right, so we do have a question from Marcel. What will this do to the Canadian dollar?
Good to hear from you, Marcel. It's been a while. To the Canadian dollar, who knows, right? So there are a lot of other currencies right now, and I think it was like 3 days ago or 4 days ago, New Zealand, out of nowhere, devalued their currency by dropping their interest rates by 0.5 point, and they were already at almost historic lows. And so with New Zealand doing this out of nowhere, they said it was because of the Chinese yuan, with the global trade tensions. They want to preempt something. But this is going to be a race to zero. All the currencies around the world, since they're backed by nothing, there's no currency right now that's backed by anything of intrinsic value. It's just paper. And so the Canadians, the Chinese, the Japanese, the Euro, New Zealand, and Australia, they can all do it as much as they want, because short term it gives you a small advantage compared to the other countries. So it's going to be a race. Everybody's going to start devaluing their currencies, dropping their interest rates. I mean, real interest rates are already below 0% when you account for real inflation. So they probably are going to be in a similar boat to us, and it's just a matter of where the chips fall when it all kind of starts to collapse.
Okay, another question. What do you suggest people do if they are already invested in bonds? It's from Emma.
If somebody's already invested in bonds, there are. Number one, it depends on what type of bonds, right? Because if you're invested in bonds that are international in certain countries that might not end up with the collapse the same way that the dollar will, the same way that the U.S. bonds will, you might be a little bit better off. But personally, for myself, I would rather get out of bonds, get into stocks, and protect my stocks with options, because then I'm buying insurance on my investments. Or instead of that, if I have a nice 50-50 split between bonds and stocks, and bonds are my conservative side, I might buy a quality gold mutual fund. Because 100 years ago, if I was having this conversation with you, I'd be saying, go into cash and bonds, because 100 years ago there was gold standard. There wasn't these problems that we have right now systemically with the Fed and the government, and so it's like, yeah, that's a safe asset. So don't be in stocks in 1928, right? Don't be in stocks in 1929. Go into cash, because you're going to need cash more. Well, gold is still money. That's why central banks around the world are stockpiling gold. So if I need to have a nice split between stocks and something conservative, I might buy a quality gold mutual fund. Don't buy any that look like that they're just deriving their value from gold by trading futures, because those have their own risks. But you can buy mutual funds that actually hold physical gold and own gold mining stocks. And so that's a much more conservative play, because in an inflationary recession, gold is going to do extremely well. It's going to preserve its purchasing power, whereas something like all cash, all currencies, and most government debt is going to collapse. Any other questions?
Yeah, there's some other ones. There's a few people asking about real estate. So how do you anticipate this inflationary recession will impact real estate prices? There's another one. Is investing in property as safe as investing in stocks through a recession? And then what will this do to the housing market? Will it cost more to buy homes?
Yeah, it depends on the type of real estate. So number one, in terms of dollars, everything is going to explode in price. If you look at Argentina, if you look at Venezuela, if you look at Russia in the 80s, anytime there's an inflationary debt crisis, the prices in terms of the local currency skyrocket. It takes a pallet of cash to buy a loaf of bread in Venezuela right now. And so in terms of the US dollar, prices of everything are going to go through the roof. And wages, unfortunately, are probably going to be the last things to catch up, because wages are still a price. It's just the price of labor, right? So wages do go up in inflationary environments. They're just probably one of the last things that gets hit by inflation, unfortunately. So the cost of living is going to skyrocket, and that includes real estate. That includes stocks in terms of the dollar. But when you measure in terms of other currencies, but especially commodities and physical goods like real estate and gold and silver, even oil, you're going to see that the real value of these things, like real estate, American real estate that's been pumped up by easy money, that is going to come down in value a lot. Now, if you're invested in cash flowing real estate, you're probably still going to be fine, especially if you're in multifamily, because if you're just relying on one door, there's a really good chance that might not rent for a while. Because in bad crises like this, people usually move in together. So the supply of real estate goes up in a big enough crisis. And so if you're relying on one door, there's a lot of risk there. If you have a multifamily unit, there's a lot less risk there, because you can probably still cover your mortgage with half of it rented or 75% of it rented. In terms of personal real estate, like personal residence, just like last time, if you can make your mortgage payment, that's fine. You're going to be fine. The value is probably going to collapse in terms of real value. In terms of the dollar, the price is going to go up, but it's not going to be doing anything for you. You're not going to be able to get new debt, because the bankers are going to catch on that debt is worthless. So their debt is being inflated away. Inflation hurts creditors. It benefits debtors. Because the value, it's just like 30 years ago, you could buy a house for $50,000 and now it's $500,000. The actual value of that house didn't change. The dollar became worth less. And so in terms of price, it'll go up. In terms of value, it'll come down to its real value, because the inflation bubble will pop that has hit real estate and stock prices right now.
Another question. Do you think the dollar is overweighted or underweighted?
It depends on what you mean by underweighted and overweighted, and compared to what. Like in the world, are you talking like supply and demand in your portfolio? Are you talking overbought or oversold? Because even then you're just comparing it against other currencies. So the dollar recently, it's been semi-volatile, and especially compared to some other currencies. But essentially all paper currencies are we're getting into this place where it's going to be a race down. Recently, China just let their currency drop below that 1-to-7 ratio that they've pegged it at and held it at. And so it's going to be a race down. And so the dollar is historically been considered, one of the safer currencies. And some people who are saying that there will be deflation are saying that dollars will be scarce, but that's the opposite of what's going to happen, because as treasuries get unloaded, the Fed is going to have to buy that up. And as the wealth effect reverses and the stock market crashes, the only way to kind of compensate for that is to print more money, push more easy money into the system. And so that's just going to create more and more money in the system, which collapses the actual value of each dollar. Any other questions?
Yeah, so there's another question. Is gold or silver the best way to preserve your investment or your investments?
Yeah, that's a really good question. So historically, there has been both gold standards and silver standards, and sometimes both at the same time, somewhere in the world for the last 2,500 years, unbroken until 48 years ago. Recently, the price of silver has been suppressed. And there are a number of factors that might have been going into that. But usually when commodities are moving up in price, silver will have a normally like twice the price movement that something like gold does. Now, historically, gold has been more of a safe haven. It's been the majority of what holds its value compared to silver, because silver has been more volatile historically. But there's more potential for bigger and better price movement with silver right now. So it's probably below its intrinsic value. So when gold goes up, usually we say that you're not making money, you're just preserving your purchasing power, because gold and silver are not investments, they're just money. An investment is something that you're actually going to make money from. Gold and silver, they're just money, so you just maintain your purchasing power with them. And so the value of silver has probably been suppressed, so you probably have a little bit more speculative potential for gain there. But either way, they're both going to preserve their value a heck of a lot more than any currency will. If you're looking for the safer bet, historically, that's gold. If you're looking for something that might provide you with a little bit more return, that might be silver, although there is a little bit of speculation built into that. But one of the reasons silver was always used as money in copper and other metals is because, 1 ounce of gold, the purchasing power of that right now is $1,500. And in terms of today's dollar, and that's that purchasing power, if you kind of track that back for the actual inflation of the dollar, it's been the same. It holds its purchasing power almost perfectly. And so you're not going to walk into a restaurant and plop down 1 gold coin for a sandwich. That's way more valuable than your daily transactions. And so people would carry copper and silver, which are less valuable because there's more of a supply, and they would use those as their smaller transactions, just like we use coins instead of $100 bills. And so that is not as much of a necessity, even if the world does return to a full-on gold standard, because we have computers now. And there are companies now where you can actually hold segregated allocated gold in your account in an insured vault and use a debit card. And when you use the debit card, all it does is in the computer, it'll sell the amount of gold that you used in terms of dollars, and then transfer dollars to your debit card basically to make that purchase all at the exact same time. So you don't need silver as money like you used to. And so that might be one of the reasons why the silver has kind of not been keeping up with gold lately. For those of you who might not know kind of my background or who I am, about 5 years ago I started working at Charles Schwab because I wanted to learn about how money works, how investing works, how, I was $20,000 in debt when I got married, and I was making less than minimum wage. And so I knew I needed to dig myself out of the hole I had got myself in. So the last 5 years, basically all I've done is studied money, and I've read books. I've gotten all the licenses there are, 763, 910, 3, the 66, just to expand everything, get into the industry as much as I could. I was an investment consultant. I trained brokers. I worked with day traders, and so everything I did, I was trying to study how this all worked. And the more I learned, the more I got scared because of what I learned, how the system was kind of on the edge of collapse. And so kind of the goal here, my company, Heresy Financial, we're trying to, pull everybody back from the edge of the cliff as fast as possible. Dave Ramsey wants you to take baby steps away from the cliff, and I want you to sprint away from the cliff. And so we're trying to help everybody prepare for this crash that's coming. And so that's Heresy Financial. That's who I am. That's kind of where this knowledge is coming from. The books that I've read and the people that I've studied under, and the kind of the time that I've invested in learning how these things work has led me to kind of go out on my own so that I can prepare people, because like I said, financial advisors can't tell you this. They're governed by the licenses, and they're bound by those rules, and so the government says they have to say bonds are safe, and so they have to say bonds are safe. So I went out on my own so I could actually tell people the truth about what I see. So there's 3 ways that we do that. You're gonna 4 ways that we do that. We help you out with your budgeting, because if you can't control your money right now in the good times, you're going to be screwed when times get tough. Number 2, we help you out with debt management, because there's good ways to use debt and there's bad ways to use debt. And if you are using debt correctly right now and not using debt incorrectly, you're going to be prepared and set up for some real nice success when this all starts to happen. Number 3, we do it through investing, because like we talked about a little bit, if you're invested in bonds, that's extremely risky right now. And so we help you out with structuring your investments. And then fourth, we do it through hedging, because there's ways to protect yourself against these things. And so we help you out with protecting yourself, and that includes your food and your house and your family and your investments all together, not just your stock portfolio. So altogether, kind of from the top, we just discussed why bonds, the piling into bonds created the yield curve inversion. That caused a sell-off in the market as a flee to safe haven. And this safe haven is probably not actually a safe haven. And if you want to protect your money, you should probably get out of bonds and protect your money in another way. I listed a podcast today. My recent episode was about options, so you can check that out on iTunes and Spotify. I've got a book on my website. It's heresy.financial or heresyfinancial.com. It's heresy.financial. And you can check it out there. I've got some books, and my podcast and my blog comes out every day. So thank you guys for watching and joining, and you guys have a great night.